All right. So it brings us to actually one of the better quarters that we've seen in quite some time. I'll go ahead and just jump right to it and get to our quarter review. And usually I get into great detail about this, but I think a couple things that pop out that are really just noteworthy about it is we have had really strong support from the central banks worldwide. In particular, Ben Bernanke and team have basically gotten together and said they're going to do whatever it takes to keep us rolling along until we at least hit unemployment rate of, I think they're saying 6.5% now is what they're actually shooting for, and certainly that has shown all through. You know, when we took some of those issues off, those Q4 issues off the table, basically a lot of investors, breathed a sigh of relief, and then noticed that we had a very strong return in 2012, and I think basically felt like they missed out on the party, and so it left investors felt a little bit left out, and so they started piling money into equity funds. Matt's going to talk about that later on, and this really turned returns very strongly. Now, it wasn't just on that. We saw really good economic reports off and on from January, February, and March. February, obviously, we saw some volatility. Volatility was directly related to first of all, we heard that Italy was going to maybe after they they actually had their elections, that they were going to maybe dismantle their austerity measure. And of course, we saw people starting becoming concerned about the sequestration issues as well. But overall, we take a look at it, and I think the bottom line for this quarter, if we look at a month-by-month review, is that we had strong support from the central banks, and that was really the main story this whole quarter as we take a look at it. People really rejoiced in that. Again, felt a little bit late to the party, but one thing that we noticed as we started getting close to all-new time highs, and when we started breaking through some of the lows that we had achieved after the meltdown in 2008, investors started becoming a little bit more conservative. So one of the stories you're going to see is, if you take a look at the bottom of this particular chart, that the out of favor areas, I'm going to call some of the defensive stock issues, actually saw some of the better performance. We saw that health biotechnology funds actually did 6.28% return. That was for the month of March. And then also we heard some really good news on GDP growth out of Japan, and also the Abe government, basically, and everybody's calling it Abe economics, basically said they were going to take a very aggressive stand as well. And so we've seen a really, really strong result from Japanese funds, and we're going to see that throughout. So let's go ahead and move down to the breakout on a more macro basis. Basically, if we take a look at equity funds as a whole, United States diversified equity funds, if we take a look at equity funds as a whole, we saw a 7.68% return for the quarter. That's the second best quarter since 1998. Of course, last year was the strongest quarter, and that was actually the strongest quarter since probably 20 years. So again, we're looking at some two very, very strong quarters back to back, and I think that's what's got some of the people concerned. But one of the issues that we saw was people were very concerned with Cyprus. Obviously, the bank deal didn't sit well with a lot of people. I think people were concerned that they could put money into European countries and in offshore areas and actually have government take some of that money away from them when they thought they were in safe money market or bank deposits, and so that was a concern as well. And of course, we are now hearing about Italy's inability to form a coalition government, and that has been a stress on world equity funds. So it's not surprising to see world equity funds this quarter only returning 3.81% and having United States diversified equity funds at the top of the group at 10.16%. We saw a lot of people focus towards small cap funds, defensive issues, and out of favor stock issues as well. And it's interesting to note that 80 out of the 90 classifications that we actually track in the equity universe had plus side returns. So it was really quite a strong return period for us. We saw diversified leverage funds. Of course, anytime we have a grand month, quarter, whatever time period, those people using leveraged, it's actually called equity leverage now, up 15.36%. Of course, I told you about health biotechnology funds up 15.53, and global health biotechnology funds were up 14.57. And with that mid-cap value doing about 13.74%, we're seeing these investors doing small and mid, and that's going to be a story I talk about a little bit. Of course, we have seen last quarter's laggard, that's gold funds, AU, down 16.93% for the first quarter of 2013, and that is something that certainly has been something to talk about. Gold declined for the quarter report about down 4.78%, but oil gained up 5.89%. So we did see a little bit in March of some natural resources groups actually doing a little bit better. Again, at the bottom, dedicated short bias funds at the bottom, but a new entrant came in, and that's India region funds. And I think people became a little bit more concerned with China and India's possible inflationary areas. And so we see that China, India region, emerging markets are at the bottom. We'll talk a little bit more as we go on. Certainly because of what has been going on, easy money, and of course some of the restrictive views that we've seen in Europe as well. We saw the dollar actually take off and do well against most major foreign currencies. So let's go ahead and move on to the United States Diversified Equity Funds Group. This group basically was the best performing quarter and month that we've seen in quite some time. When we take a look at the leaders in this group, basically diversified leverage funds and dedicated short bias funds were the worst and second worst and second best performing groups in the universe. Again, diversified leverage up 15.36%, dedicated short bias funds down 11.57%. It was quite a story when we're taking a look at how well diversified equity funds did. But again, it's not too surprising considering people's, I'm going to say, risk aversity from going overseas. And even in the sector areas, we're going to see commodities took it on the chin, and they really went back to what's been out of favor and out of tune, to the tune of, Matt's going to show you that actually flows here later on were very strong in diversified equity funds, and that's not something that we've seen for quite some time. So that was the story. When we get down to the March performance, we see that they actually returned 3.6%. Again, best performing macro group in that area, and of course, we're starting to see the small cap funds start roll into this. One thing to note, though, that the 6.15% for diversified leverage was one of the higher returns that we saw during that time period, and we actually are going to have to look at Japanese funds to outpace that later on when we get to the World Equity Funds Group. This is just to show you what was happening. As I was rambling to you, small cap funds actually came in favor. So we see mid cap and small cap funds at the top. Of course, equity leverage funds are at the very top of the thing. And if we take a look at the bottom, large cap. So I think investors have become a little bit discouraged with the, let's call it the Apples of the world, and have really, saw that large cap funds were, the rally in that group was actually getting a little long in the tooth, and decided to put their money elsewhere, and so we saw some favor running into the small and mid-cap areas. In fact, when we took a look at the large cap groupings, we ran that against the Lipper active indices, and we saw that large cap growth funds, which is the worst performing of the 4x3 macro group, large cap growth funds were hindered in Q1 by heavy weighting in information technology, of which Apple had the largest impact, dragging down returns by 104 basis points. So we really do see that some of the growth-oriented funds that were actually some of the go-go's maybe 3/4 of a year ago certainly were out of favor and pulling down returns. Now, granted, they're still positive, so don't get me wrong, but certainly that was one of the issues that we were taking a look at as well. So let's go ahead and move on to the our other breakout, and it's basically showing who's done what. For the first quarter since Q4 2011, small cap funds rose to the top. So we see this huge dichotomy, a 12.15% return between the large cap and the small cap, 9.84 for large cap funds. And then if we take a look at value versus growth, we see value handsomely outpacing their growth-oriented counterparts, 12.03%. This is the fourth consecutive quarter, though, that we have seen value funds at the head of the pack. And this makes sense if you take a look at it. Basically, investors, again, taking a more conservative approach, we're basically looking for dividend payers and value-oriented types of funds. And so this is one of the things that we saw was prevalent, and it actually runs through kind of the whole theme, even as we get into the World Equity Funds Group. Let's go ahead and take a look at what happened over the month, though. Here we have the monthly returns, same type of thing that we saw with the month of March. Small cap funds are at the very top of the group, 4.49%, but there's not quite the disparity. About 100 basis points separate large cap and small cap, and not even that much amount, about half that amount separates value and growth. So it wasn't quite as profound, but what we did see is that small caps, this is the best performing month in 3 months, and for the value-oriented funds, it was the fourth month in a row that value outpaced. So certainly that was some strong performance as well. Well, let's take a look now at the sector equity funds. And this is one of the things that we talked about last quarter as well, that there was a, if you will, a good supply of base metals out there and some of the natural resources funds. So it's not surprising to see these commodity-based funds at the bottom. And commodities basically saw a weakness because there was a lack of inflation, and obviously a lot of the world groups that were taking in some of these base metals and commodities are cooling their jets a bit. And so what we saw was at the top of the group, health biotechnology funds, 15.53%. It's basically one of their best returns that they have seen in quite some time. In fact, you'd have to go back to the second quarter of 2003 to have a better return for health biotechnology. Remember, I was talking about defensive and also conservative type of investments. Global health, 14.57%, and even financial services funds did well, 11.60. The typical pariah, gold at the bottom, 16.93%, followed by commodity base metals, and then followed by commodity agriculture, both losing 6.89% and 4.52% respectively. As we get down to the month of March, health biotechnology, general global health, and now utility funds. Remember, I was talking about dividend plays coming into factor and out of favor. So utility was both a dividend play and an out of favor area, returning 4.7%. And of course, we continue on with the demise of basically the commodities group. One thing I wanted to point out is of the 10 classifications that we saw losing money this quarter, this group housed 6 of those, so that was kind of an amazing statement. Well, let's go ahead and move on to our the picture, if you will, of what's going on. And again, we can see that these defensive issues, health, biotechnology, global health, financial services, natural resources, utility funds are at the top. And then as we get down to the bottom, it is all either base metals or commodity-based groups that are at the very bottom. So certainly that's a telling story. And we take a look at the world equity funds, and this is something that we haven't done in a while, but basically they deserved the lowest rating or ranking within the first quarter of 2013 and also in the month of March. So they were at the bottom of the group for both cases. An interesting thing that we saw is basically with Cyprus crisis, basically looming overhead, people kind of pulled back, and also we had some discouraging news with the leader of the Italian center-left Democratic Party, basically making some bold statements and saying that only an insane person would want to govern Italy, and the country is in a mess. And when you hear statements like that, and you know that many of the countries in Europe are basically teetering on recession, if not in recession, certainly that caused a lot of people to pull back. But interesting enough, if we take a look on one step further, and we saw Japanese GDP grow about 0.2%, and the new Abe government basically saying that they are going to return to a mild inflationary growth pattern. This was a very big statement, and certainly well received by the market. Japanese funds up 12.75%. The global multi-cap value funds, here's that value story I was telling you about, 7.90%. And the international small mid-cap value funds, 7.73%. So even in this area, if they got small and were value-oriented, we saw international doing better. But when we took a look, global really did a good job of outpacing because they had that United States focus in there as well. So they were able to mitigate some of the hardships that were suffered from some of the internationals. At the bottom of the group, again, I was talking about inflationary fears. The India region funds down 7.47%. China region funds losing 1.79%, and emerging markets down 0.17%. So this was kind of an interesting time. This is the first quarter in 3 that we've seen them at the bottom of the pile. So really, people were very interested in world equity funds the prior 2 quarters. In fact, last quarter we were talking about it being the top performer, and now it's gone from first to worst. And again, got a 3.81% return, so we're not going to, beats a poke in the eye, but certainly it's one of those concerns that we had as well. And March obviously did very well, up 0.89% as far as performance goes. It's still a bottom performer, but again, we got a solid return, so we're not going to shoot that down. But again, that was carried on by very strong performance. Remember, I told you top performer in the group. Japanese funds up 6.15%. In this group, the next best performing group was only up 2.87%. So keep an eye on Japanese funds as we go forward. Taking a look at the global and international 3x3 matrix breakout for the first quarter, we see that growth actually did better on the international side, but of course small and mid cap was the outpace, was the winner of the group, and we can see that 6.81% versus 3.37. Now when we get down to the value, core, and growth continuum, not that much of a separation, but again, growth was basically more in favor. If we go to the global side, though, and again, something with a little bit more U.S. focus, investors were more value-oriented, and again, preferring small and mid-cap type of funds. So if we take a look at the world returns and we pop up this next piece, this is the piece I was telling you about. We saw small and mid-cap type of funds doing best, but when we had international peek their head into this top group, it was because they were going to small, and I'm sorry, going into small cap, small and mid-cap groups. So basically, this was a small, mid-cap, and value-oriented group. Global was at the top, and if we look down at the bottom, basically international, and then we have a separation of the single countries and regions. So European regions are at the bottom, India region, China region, emerging markets are at the very bottom, Latin America. We'd expect those groups that are providing the natural resources or users of these natural resources to be at the bottom. So I don't think there's any shock or awe here. Certainly one of the things that's covered up right here, Japanese funds, look at how well they did for the quarter. Quite amazing returns. So if we take a look at the Q1 returns for the mixed asset funds, I always like to point out what the mixed asset funds group have done, because a lot of the money is going into this group. For Q1, a healthy return, 4.53%, again for a mixed asset fund doing both fixed income and equity together. I don't think anybody will scoff at 4.53%. At the bottom of the group, we see absolute return funds at 1.60%, and at the top of the group, target 2050 plus funds return 6.90%. So obviously this was a really good quarter for them. One of the things that I always point out is the flows, though. Flows have changed a bit. So as a group, and when I say the group, we got four broad-based macro groups that we just talked about. They took in about $107.6 billion. That was through February 28th, 2013. Matt might go into details on this, but this also includes some fund of funds in there as well, so he probably won't cover too much. United States diversified equity funds finally in the black, took in 16.4. Sector equity funds took in 9.1. World equity funds, as I said, was in favor there, prior quarters as well. $40.4 billion net new money. However, the mixed asset group once again took in the most out of all four groups, $41.7 billion. Again, something we need to keep an eye on, because obviously our clients are putting money to work in the mixed asset group area. Well, let's go ahead and move to the final piece, and this is what I have concerns over. Obviously earnings and guidance coming forward is going to be one of the most important things, and I think there's two things we're going to be looking at: earnings and guidance, and unemployment, and actually what the Fed does, really. So that sums it up for the whole thing. But there's individual things that came out recently that are of concern. Obviously, non-farm payroll is disappointed, 88,000 versus what analyst expectations were, 190, and a lot of people are talking about maybe there will be even more of a slowdown if sequestration worsens. So we might be losing some positions there. Globally, we have Italy. It cannot form a coalition government. Cyprus, obviously, this is more of a concern of, can this be rolled forward into other banking systems? So there are some concerns that basically the governments could basically take some of the hard-earned earnings from investors right out of the bank. And of course, we have saber rattling in North Korea. That is of concern, and uncertainty is still present. The debt ceiling is ever present, and it's something that's going to be taken up, I think, in mid-May sometime. So certainly this is going to be a concern going forward. And the last couple things, we have subpar growth. Again, spending is going to be down by the government. That's good. We know that generally that the private sector will step in when the government steps away, but certainly that could cause some problems as we get into the next several months, particularly in summer when usually people use the old adage, sell in May and go away. We have a lot of issues coming up. And of course, the ISM manufacturing, non-manufacturing numbers were somewhat disappointing. Last night, though, we heard Alcoa beat analyst estimates, and so that would put a little little rosy complexion on the market as a whole. We heard that personal income and personal consumption was actually on a rise in February, so that was good news. And again, the last piece, I think probably most importantly, is this Fed continues to support quantitative easing, and the central banks overall are very accommodative. So certainly it sets us up for continued good performance, but we've had such a strong return in Q1. A little bit of a meltdown and maybe a pullback would probably be healthy. I mean, we go back to the top concerns, markets at all-time highs, and I think investors, even though they felt a little bit left out, and that's why we're seeing investors still put money to work, they are very nervous and they're selectively going in. Again, defensive issues seems to be the way to go. So that would be basically my view of what's coming up ahead, and certainly, like I said, I hope if we do have a little pullback, it's just that, a pullback, and I expect a good year going forward. Well, that's it for me. I'm going to go ahead and hand off to Jeff, and he'll talk to you about the fixed income universe.